Assalamualaikum warahmatullahi wabarakatuh. Alright, so this video is to discuss the past year of February 2025 of our financial statement topic only. Right. It is basically past year question one. Alright, so we proceed to the question. Okay, so first thing first, the question will give you the trial balance. In this question, it is focused on the company name Cr, right? And the trial balance given to you here as at 31st December 2024. Okay. First thing first, it is the year end is 31st December 2024, and we know if it is 31st December 2024, it will start the accounting period on 1st of January 2024. And therefore, within this period, we are going to do the financial statement. Okay, so first thing, I would like to discuss the adjusting entries based on the question. So the first adjusting entries, the question highlight the land and the building were previously revalued in the year 2019, which result in deficit of 900,000 and 500,000 respectively. The deficit were written off in the statement of profit or loss in that year, or I mean that in 2009 year. Okay, remember, so we are doing in 2004. So the deficit happened in 2009. So mean that it is the previous year deficit. Okay. Since then, the building was depreciated over the remaining useful life of 45 years. Okay, again, this 45 years is yes, it is a remaining useful life, but then it is for 2019. 2019, the remaining useful life for 2019, right? So on 31st December 2024, the land and building were subsequently revalued, and the value was revalued to 46 million, while the building is 66 million, right? So first thing first, this is I highlight the related land and building only. Okay, so we are going to use this information to prepare our working. Okay, so first thing we do for land. Okay, so we know land, as highlighted in this question, the previous deficit was 900,000 here, 900,000. Okay, the revaluation. Okay, in order for us to do revaluation, we need to compare the revalued amount, which is 46 million here, and the carrying amount, which is 44,850,000. So by comparing this, we can see that the revalued amount is higher. Because this is a revaluation, mean that there is a surplus. There is a surplus by how much? So we minus these two and we get 1,150,000. Okay, surplus is 1,150,000. Okay, because previously we have a deficit of 900,000 before we record the surplus to asset revaluation reserve or ARR. So we need to set off this deficit. In order to set off this deficit, yeah, we put on credit side surplus which go to Sopol direct by 900,000, because the previous deficit also go to Sopol, but the previous deficit is on debit side. In order to balance it, we put on credit side Sopol 900,000. Now debit side 900,000 and credit side 900,000. Now it is balanced already, so it is equal to 0. Okay, and the remaining go to ARR by 250,000. The remaining land, of course, are going to increase by 1,150,000, which is this one. Okay. So the next part is for building. Okay. Again, the previous deficit for the building is 500,000 according to the question. 500,000. The revaluation is 66 million according to the question. Now we have to determine how much the carrying amount. Building is different from land because building have a depreciation, and this question, the revaluation is done at the end of the year. Because it is done at the end of the year, we need to calculate the depreciation first, because depreciation is already happened during the year. Again, the revaluation is done at the end of the year. If the revaluation is done in the beginning of the year, no need to calculate depreciation in order for us to calculate CA. Now, because the revaluation is done at the end of the year, so that's why we need to calculate the depreciation first. So yeah, we calculate the depreciation first. The depreciation is 72,720,000 divided by 45 years, which is given in this question as remaining useful life in 2019. So we just divide that, right? And we get the depreciation by 1,616,000. Yeah, depreciation. Just do a normal depreciation, debit depreciation for building, credit accumulated depreciation, 1,660,000, normal, right? Okay, then we proceed to the revaluation. So now we get the carrying amount. Carrying amount, which is a cost less with accumulated for this the beginning balance plus with the current year depreciation, we get the total accumulated depreciation, which is 8,080,000. All right. After we minus, we get the carrying amount by 64,640,000. After we get this carrying amount, we compare with the fair value, revaluation value, 66 million. And if we compare, we can see the revaluation amount is higher. Mean that we have a revaluation, a surplus. We have a surplus on revaluation by 1,360,000. Again, remember, we have a previous deficit by 500,000. Same case with the land, we need to write off this deficit first. So therefore, we put on credit side again a surplus, which is go to support to write off the previous deficit, 500,000. And the remaining go to ARR, or asset revaluation reserve. The building still increased by the amount of its revaluation increase, which is 1,360,000. Right. So this one is for land and building. We proceed to the next one. Right. So remember, the pair for revaluation is also you need to eliminate the accumulated depreciation. This one in the previous slide, I missed to explain that part. So, but you can refer to the previous slide. We need to eliminate the accumulated depreciation. To eliminate accumulated depreciation, we debit accumulated depreciation and we credit the asset itself. In the previous case, it is a building itself. All right. So now we proceed to the next point or next information here, additional information. So this information included in the plan, and equipment was a new plant which is acquired on 1st of January 2024. An installation cost of 1 million was incurred before the plant was operated, and the plant was also scheduled for yearly maintenance of 10,500 per year. Right, both costs has been written off in the statement of profit or loss, and as part of administrative expense during the company depreciate its plant and equipment using straight line method of 20 years. Okay, so this is the information that the question gave to us, right? All right, so first thing first, we try to record what happened here. All right, so again, as mentioned here, included in the plant and equipment, included an installation cost by 1 million uh, before it is operated, and also the yearly maintenance 10,500, right? So by read this the adjusting information here, it is assumed that the company record like this: debit admin expense for maintenance 10,500, debit for admin expense so for installation 1 million, and credit cash, which is they paid 11 million and 10,500, right? So we know that uh, cash has no problem in this case. Cash has no problem in this case. Admin expense for maintenance, which is this is a yearly maintenance, is clearly expenses, right? So there's also no issue in this case. The issue here is the installation. Installation should be capitalized. It should be as part of the PPE cost. In this case, the PPE cost is plant and equipment. It should be a plant. It should be part of the cost of plant. But in this case, they put inside admin. So this is the wrong. This is the error. So therefore, this is not admin expense cost. So therefore, what should we do here actually? So because it is not admin expense cost, okay, therefore we should take out from admin expense, you see, credit admin expense, we take out from admin expense. Expenses increase on debit side, right? So now it is decrease on credit side. So credit admin expense, and we put to the place it should be. So debit plan 1 million and 1 million. See, the error they put on debit side. So in order to correct this, we need to put on credit side. Credit side. And we put on debit side the correct one. The correct one is debit plan 1 million. Okay, and then the new cost of the plant is the old one, the original one, 43,900,000 plus with this 1 million. It is equal to 44,900,000 because the question gives us the useful life. So we straight away calculate the depreciation. So depreciation is 44,900,000 divided by 20 years, and we get 2,245,000. Depreciation, normal depreciation, debit depreciation, credit accumulated depreciation. Normal, 2,245,000. All right. The one is more point number 2. So next for the point number 5, okay, on 1st January 2024, beginning of the financial year, my Berhad entered into sales and leaseback arrangement with Health EQ Berhad for one of his plant at a fair value of 6,200,000. The plant, which was acquired 10 years ago at a cost of 10,200,000, has a remaining useful life of 10 years. The present value of the lease payment is 4,196,000. My Berhad agreed to pay eight equal annual installment of 650,000 starting from 1st of January 2024. The interest rate implicit in the lease agreement is 5%. Right? So first thing is, in this case, okay, again, this beginning of the year, right, the payment of installment is in the beginning of the year. Right? So in this case, first thing first, you have to decide, you have to identify whether it is a sales and leaseback or it's just a loan with an asset as guarantee. Right? How do we decide whether this one is sales and leaseback or not? Okay, this is some sort of like guide how to decide, right? So we know that the land have the asset have the remaining useful life of 10 years, okay, and the lease term is 8 years, right? So again, remaining useful life is 10 years, the lease term is 8 years. We can assume that 80% is maintained to the owner. Again, we know already the case of sales and leaseback. This one is the original owner. In this case, it's my care. Okay, this one is the buyer. Okay, we sales. Here's sales, right? Sales and then lease back the asset. Lease back the asset, right? Sales and lease back. So we need to know how much actually maintained here as the original owner of the asset. So in this case, 80% is maintained to the original owner of the asset. Even though we sell, but it still maintain 80% to us, the MyCare. So therefore, significantly maintained to the original owner. And therefore, we cannot assume this as sales and then leaseback. We need to assume this is just a loan because actually the asset is not moving anywhere. The asset is maintained with my care. Therefore, it is just a loan. If it is just a loan, then how should we do this? Okay. Because if it is just a loan, therefore, in order for us to proceed with this, it's just receive cash because of loan. How much? You see the fair value. Sales lah, sales price lah. The fair value, 6,200,000. The fair value when we sell, right, we are following the market price or the sales price or the fair value. Market price, market value, and fair value is similar, right? So 6,200,000 we receive cash. So debit cash, credit loan. Loan here I record as financial liability lah to make it different because it is sales and leaseback loan, right? So it is credit debit cash, credit loan, financial liability loan, 6,200,000. Right? And now, what else happened on 1st of January 2024? There is a payment of installment, right? So we record there is a payment of the loan by payment of installment of the loan. So debit loan, credit cash, 650,000. This is the payment of the loan, right? Debit loan, credit cash. That. Okay. And then what else happened? The interest payment, this one at the end of the period. Okay, interest always at the end of the period. In order for us to charge interest, there must be a timeline first. Okay, therefore, at the end of the period, how to calculate interest? 6,200,000 less with interest. You see the word here, loan and loan, right? So loan increase credit, loan decrease debit. So that's why I minus here. And then times with 5% because the interest rate is 5%. And then we get 277,500. How to record this? We record as debit interest expense, credit loan. Because interest are going to increase loan. This one, interest are going to increase loan. Again, you see, the payment is on installment. Interest is paid together here. Okay, so therefore we cannot record interest payment as we cannot record interest as the payment. Interest will increase only increase loan. It is not a payment, right? And the balance of loan, so this one we have to decide. So the balance of loan, the financial liability, the loan is half, but it should go to non-current liability or current liability. Okay, so first thing first, we need to understand the definition of non-current liability and current liability. We know that current liability is short-term, can be realized or will be paid within 1 year, while non-current liability will be paid after 1 year. After 1 year, mean that it is long term. All right. So therefore, in this case, if we follow the installment is at the beginning, right? Okay, first thing first, we know that the installment at the beginning of the year. Therefore, by rule, the installment at the beginning of the year, it will not affected by the amount of interest because it is at the beginning of the year. It will not affected by the amount of interest. Therefore, the current liability will be a full installment. Current liability will be the full installment, which is, okay, this is basically the balance of the loan. So 6,200,000 less with 650. This one, you see credit, debit, credit. So increase, decrease, increase. At the end, the balance of loan will be 5,827,500. Okay, so when I say payment at the beginning will not affected by interest, so current liability is full installment. Installment is how much? Installment is 650,000. Therefore, our current liability will be 650,000. The remaining will go to non-current liability. So then 5,827,500 less with 650,000. So this one will go to non-current liability, 5,177,500. Okay. Point number 4, as at 31st December 2024, the fair value of the investment property increased to 23,560,000. So the company adopt a fair value model for all of its investment property, right? So this one is easy. We compare carrying amount, take it from here, the question, 22,500, and the fair value, take it from the additional information, 23,560,000. Then we compare between these two. We can see there is an increase by 1,060,000. Increase by 1,060,000. To record increase, it will increase the value of investment property, right? So investment property are going to be on debit side. Investment property 1,006,000, and credit side is go to support because it is a fair value model. Everything go to support whether it's increase or decrease. In this case, is gain on investment property 1,060,000. Okay. Next, number 5. The 5% of bank loan is a foreign loan taken from BC Bank in Germany. Okay, right. This one, this 5% loan. To purchase an equipment on 1st of July 2024. Okay, never mind. When the exchange rate was Euro 1 equal to 4.8 ringgit. At the end of the financial year, the closing exchange rate is 4.95. Okay, in this case, right, on 1st of July 2024, in this case, 9,600,000 is at a Euro 1, which is 4.8 ringgit. 4.8 ringgit. Okay. As we can see here, 4.8 ringgit. 9,600. This is what we record, right? 9,600 is what we record. We need to pay. To German, right? We need to pay to German. And when we pay to German, we cannot follow our RM. We need to follow their currency. And their currency in this case is the euro. So we need to know how much euro actually we owe to Germany company. Okay, because we need to pay back to German in euro. So we need to know how much euro cost euro, how much euro. So in this case, we reverse first 9,600,000 divided by 4.6, and we get a euro of 2 million. Actually, we owe to that company euro 2 million because we owe to that company euro 2 million. Okay. At the closing date, which is 31st December 2024, the exchange rate is different. And because the exchange rate is different, so we need to recalculate back how much actually we owe to the company. Okay, again, in euro, we still owe 2 million. Right, in euro, we still owe 2 million. But in Malaysia, we need to record in RM, right? Now the currency is different. 4.95. The last one is 4.8. Okay, because it is 4.95, then we convert again at the end of the year. Now, our loan become RM 9,900,000. So you see, originally our loan is 9,600,000. Now it's 9,900,000. So by right, it is increased by 300,000. So increase in loan, is it good or not? So increase in loan, increase, right? So credit side, 5% bank loan by 300,000 credit side because loan increase. And debit side is a loss because expenses record on debit side. So it is a loss in foreign exchange, which is we transfer to Sopol by 300,000. Okay, the next one, number 6. The director estimate the tax expense for the year is 31st December 2024 was 3,150,000. Okay, in order for us to do tax, I prefer you do in this T account. This is the format of tax. Okay, this format of tax line. Again, taxation is expenses, so that's why cash is on debit and top all is on credit side because we want to close on credit side. Okay, recoverable is asset, that's why debit side. Payable is liability, that's why it's on credit side. So BD here, you can see here, right? Cross check. Okay, right. So I just follow the question, what the question give to us first. Okay, first thing the question give to us here is the payable 1,235,000. We just put in payable beginning of the year, right? 1st of January. Next, what else the question give to us here? Next, the question give to us here the what the paid, tax paid. Paid mean that cash or bank, paid, right? Paid. So we record paid 3,980,000. All right. Next, what else the question gave to us here? Expense. Expense is support, expenses. Support 3,150,000. Then balance up these accounts. So total up, balancing figure will be on the credit side because this on credit side, it will be the payable CD, ending balance payable. And these two we are going to record in Sopol. Sopol is Sopol expenses. And the payable, which is tax payable on SOPI under current liability. All right. In order to proceed from this, I just take from the notes number 1 until notes number 6, whatever adjustment that I'm going to put. When you are doing on your own later, no need to do like this because you are recording your working, right? So you just cancel from the working. I show you here because I don't have enough space to show everything in one slide. Okay, so I just take all the adjustment from notes number 1 until notes number 6 and I put here because I want to show you how I cancel and I do. Right. So first, what the question asks you to do is a Sopol. Okay, this one is 12 mark. So Sopol. Again, this is a statement. This is a format. This statement, when it is a statement, it is a format following MFRS. Therefore, we need to follow a format. We cannot simply change the format. And if we change the format, it is wrong. Okay. So since it is format, we start by company's name and statement of profit or loss and other comprehensive income for the ended 30th December 2024. Just copy this question. Just copy this question and put it here, right? So I'm going to do in one column form, right? So again, because this is a format, we need to follow the format. Start with a revenue. So we take from revenue, no adjustment from revenue, no additional information, adjustment on revenue. Just put the revenue here, and after we put here, we cancel. You can see I cancel already tax payable and tax paid because we do already tax payable and tax paid in the additional information number 6. Okay. Next, according to format, is cost of sales. Cost of sales, also no adjustment in the additional information. Just take it from trial balance, cancel, put it here. All right. By format, revenue less cost of sales, you get a gross profit. This is by format. And after that, we do adjustment for other income and expenses. So here, I decide to do other income one by one, and then I combine the expenses. Okay, so I start with here other income. I start with other income. So other income in this case we just have one here, no other income other than this in the trial balance. So I just take it here and put it here, no issue in this case. Again, what else? Okay, I want to do income first, other income first, right? So income is on credit side. Okay, income is on credit side. If you refer here, no more income on the credit side, no more income. Therefore, we go to the additional information. Okay, if we look into additional information, is there any other income that we can see? Yes, you can see the first information. We have credit surplus, support, right? Support, this one is support, right? So the first one, why do we have a surplus of support there? Because this is the to encounter the previous deficit. So we do support here. So again, reversal from deficit revaluation, land, which is 900,000. Okay, 900,000. I put it here, cancel because this one we put already. I cancel. Okay, then check what else. Yes, we have for building. Now we have for building. Again, same case, reversal for building, cancel, and put it here, 500,000. All right. What else? So we search for income on here, income on credit side. First, we search for income first. Now. So income. Yes, we have one more here, investment property. We have credit, SOPOL, which is gain in investment property. Gain for investment property. 1,060,000. I put it here and cancel that. All right. What else do we have? Tax is no okay. Done. Everything is done. Everything on the income is done. The other income is done. Next, I proceed with the expenses. Now, expenses we have admin, selling, and finance expenses. But because this one is a lot, so I decide to do a working. In fact, in the final exam, you need to do working for this three. At least for this three, you need to do working. No choice. So working, we proceed to the next. Okay, this is like for working. All right. Admin, selling and distribution, and finance. So first thing first, we take from the trial balance all the item here. Just take from trial balance, put it here. Cancel. Okay, just take from trial balance, put it here, and cancel from trial balance. Okay. After that, we see what else expenses should we put. If you refer to debit side, of course, no more expenses on debit side. And therefore, you have to go to the additional information, the adjustment that you do just now. Again, expenses is on the debit side, right? So focus more on the debit side. And you can see you have here depreciation. Right, depreciation, right? So depreciation for building 1,616,000. So admin depreciation is always admin unless the question mentioned otherwise. Unless the question mentioned otherwise. What else? What else? Depreciation for plant here. Depreciation for plant. Okay, depreciation for plant and equipment. Yes, cancel and put it here. What else? Interest expenses. We have interest expenses here. So yes, put it interest expenses. But interest expense is under finance. So put it under finance here. 2,077,500. Okay. What else? Investment property. No. Loss in foreign exchange. So we have a loss in foreign exchange here. Yeah. Loss in foreign exchange. Put it here as gain. Cancel and put it here as admin also. Okay. What else do we have? Tax expenses no need. Okay, what else do we have now? Okay, guys, if you refer to this, remember you have this one information number 2 error here, which is you record as admin on credit side, right? Because there is an error we record in the previous year, the error that we record earlier, which is we debit admin. It shouldn't be admin, but we debit admin, right? So therefore we need to take out from admin. Because it happened during the same year, it does not affect our return earning. Different from different question, different. Other question, sometimes it is affect previous year. Because it affect previous year, we need to adjust in return expenses, return earning or return profit. But now, because it happened during the year, so we can just adjust the admin expense itself. Because it is error, we need to take off from admin expense. You see admin expense, but we put on credit side. What does it mean? I mean that it is a decrease in admin expense. So I put here as error is installation, and I put admin a negative 1 million. Negative, I also cancel here, right? Because it is cancel, done, cancel 1 million. All right. Then that's it, right? That's it. So total up, we get the total. We bring all this total, selling distribution, no adjustment, but never mind. Okay. We take all these three total and we put it here. That because it is expenses, we have to minus. That's it. Settle, solve this one. We are going to get profit before tax by 40,671,000. Profit before tax, this one. Okay, after profit before tax, by format, we have to follow to expenses. Expenses, again, we just take a tax expense that we do here, take it here, put it here, done. Okay, by format, profit after tax. Okay, again, because it is we have a support and other comprehensive income, we have to proceed with other comprehensive income. Again, other comprehensive income is for disclosure purpose. Therefore, no need to cancel anything. Again, how to know it is other comprehensive income? We see whether it is ARR or not. So we see information number 1 and information number 2. We have ARR. No need to cancel because this one is for disclosure purpose only, other comprehensive income. So you put these two ARR, surplus in revaluation of land and surplus in revaluation of building, 250 and 860. Okay, put it there and total up, we get a total comprehensive income. Again, This one is for disclosure purpose only. No need for us to cancel. Okay, again, this one is for disclosure purpose only. Okay. Next, what else should we do? Alright, so next thing under FAR510, what we need to do is the next part is we need to calculate the basic EPS, basic earning per share. So this is FAR510. Okay, in order to calculate the basic EPS, this is the formula. Profit after tax less with preference dividends divided by number of ordinary share. Okay, so profit after tax is profit after tax. Profit after tax here, not total comprehensive income. It is a profit after tax. Okay. Less with preference dividend. How to get preference dividend? In this case, the preference dividend is given in the trial balance. So we just take it. No adjustment because no information that it is not enough or anything. Okay. So we assume it is the preference dividend that we have. Okay. The next part is number of ordinary share. What is number of ordinary share? Number of ordinary share is in number. It's not in RM. This one is RM, right? How do we know how many number of this? Okay, the question give us RM1 each. So RM 100 million divided by RM1 is equal to number RM 100 million lah. Similar lah because the RM1. Therefore, in this formula, okay, we proceed in this formula. Net profit after tax less with preference dividend divided by number of ordinary share 100 million. Number of ordinary share. So therefore, when we solve this, we get RM 0.09 per share, 9 cents per share. Okay, the way for us to announce it, RM 9 cents per share. Enough for you to do this. Enough. Enough. In essence, enough for you to do until this for EPS, basic EPS. Right. So the next part. So the next part, guys, is for us to proceed with statement of changes in equity. Okay, statement of changes in equity for the year ended 31st December 2023. All right. In order for us to proceed with this, again, it is a statement, so it is a format. We need to do a company's name and the title. So again, equity involved in this case is ordinary share capital, preference share capital, retained earning, and ARR. How do I know this thing happened? Because in slide we have ordinary share capital, retained earning, preference share. And also we have ARR in the additional information. So we have this four. Okay. So because we have this four, I do 4 column. Okay. So first thing first, we just take it from the question, balance BD from the trial balance. Okay. And put it here, cancel, put it here. And just put like that and cancel from the trial balance. Okay. Next thing we see what happened and what is the adjustment. Okay. First thing first, we take from the profit that we calculate just now, we just put it here. Take from the profit just now and just put it here. 11,591,000. Okay, just take from the profit and put it here. Now, okay, then the surplus on revaluation of land. Okay, the surplus on revaluation of land, it have this one ARR, right? So we just see what happened in ARR. Okay, land is 150,000. Go to ARR. Okay, cancel and put it in ARR. What else? We have another ARR here. Again, surplus on revaluation of the building. Just cancel and put it here. What else do we have here? What else? What else? Next should be dividend. So in this case, dividend, we only have this dividend. Cancel and put it here. Okay. Next, what else do we have here? That no more. So we just total up. And this balance is the balance that we should transfer to SOFP or Statement of Financial Position. Right. So here the last C, the question asks you to do a statement of financial position and the notes for property, plant, and equipment, right? Again, it is a statement. Again, we start with property, plant, and equipment, but again, the question asks us to do a notes, right? So we proceed with the note first. Note first, okay, so this is the notes line. So for property, plant, and equipment, okay, so this is the format, right? This is a format. It's not really a statement, right? So you can do, if you don't like to do this way, you can do other way. But I strongly suggest for you to follow this actually, because this is to simplify everything. Okay, so first thing first, we have a cost, we have accumulated depreciation, and we have a carry amount. This is the 3 segment. If we have impairment loss, we need to have accumulated impairment loss, but in this case, we don't have any impairment loss. Okay, so first thing, we just take from the question as at 1st of January 2021 for land, building, plant, and equipment. Just take the beginning balance and put it here. For accumulated depreciation, similar, just take the beginning balance and put it here. And sell from the trial balance and put it here. Everything we transfer here. After we transfer, we cancel. Okay. Next thing, then we see in additional information what happened. So you can see in the point number 1, debit line, right? So debit line means that increase, right? So increase a surplus of line, which is 1,150,000. So we put it here. What else? You can also see here that we are having a building here. Building is also increased here, right? So put building, surplus on building, 1,360,000. Okay. What else? Okay, you can see in this information, right? So debit accumulated depreciation, credit building. This one is for us because we eliminate, because we do a revaluation, right? So I put here as elimination for building, for cost and for accumulated depreciation. Both have, right? Both is cancelled. So both is minus 8 million and 80,000. Both is minus 8 million and 80,000. Okay, what else? uh, we go for cost first line if possible. So you can see here number 2 is a plant here. So it is addition of new plant here by 1 million. What else? No more. Cost is done. After cost is done, then we proceed to accumulated depreciation. So you can see there is accumulated depreciation here because of the depreciation, right? So it is a charge for the year, 1 million. Put whatever we have here. This depreciation for plant and depreciation for building, we just transfer here, just for the year. Okay, then everything is transferred, then we total up cost, total up accumulated depreciation, and cost less with accumulated depreciation, then we get a carrying amount. Okay, this carrying amount, we total up everything, plus and equal to this figure. This is the figure that transfer to our soft P. So we just take this figure and transfer to soft P here. Here we transfer this figure, 132,677,000. Right, then we proceed. The next part that we have are the non-current asset. Just see what item that we haven't cancelled yet in this trial balance. Easy for us to do that. We can see everything is cancelled except intangible asset. So we proceed. Intangible asset is non-current asset. Tangible asset, no adjustment. So we just cancel and put it here. Inventory is not non-current asset. Investment property, investment property that we have, okay, we put it here also. But investment property, we have adjustment. So we just take it from here. And we have adjustment investment property here. Right. Debit, right? Debit means that it is increased, right? So we add 22,500,000 plus with 1,060,000. So we total up, we get 23,560,000. Okay. And then we proceed trade, cash, loan, done lah. For non-current asset is done already. Okay. So we proceed for current asset. In current asset, again, we have inventory. So we just take it inventory, no adjustment, put the figure there. After we transfer, we cancel. Remember, because we don't want to get confused later. Next, trade and other receivable. Here, trade and other receivable, no adjustment. Just put it and cancel. And then we have what else? Cash and bank. Cash and bank. Cancel, but we have adjustment. Okay, we have cash here. We have cash here. So there's a debit increase for cash asset, right? Debit increase, credit decrease. So we do adjustment. Increase by 6,200,000, decrease by 650,000, and then we get the answer. Okay, and then we see what else. Debit side is for cash, right? What else? Everything we cancel already except for dividend paid. Actually, dividend paid is also done because we done in the Sochi. This one is cancelled already actually. You see, everything is here done. All asset is done. In fact, if you look at additional information, debit side for loan only. Loan is not asset, right? So we know loan is not asset, right? This one is not debit. This one is just information. Done. Everything is done. So we total up, we get the total asset by 254,307,000. Okay. Next, we proceed with equity. Again, equity we take from the Sochi statement of changes in equity, and the share capital here is only share capital plus with preference share capital, 100 million and 50 million. Total up is 150 million. We take from Sochi. Return earning take from Sochi, and asset revaluation reserve take from Sochi also. Okay, then. Okay, then what else? Then what else? Okay, so guys, I do this. The one that cancel, I delete already lah because not enough space here. Okay, then I proceed with non-current liabilities because that all left like non-current liability and current liabilities, right? So for under non-current liabilities, okay, so we proceed on credit side. We see a 5% bank loan here, right? 5% bank loan. Okay, remember this one is the one that we do the credit bank loan here. This one is the loan from Germany, right? Just now, right? So it is on credit side. It is adjustment on credit side, 300,000. Credit for loan mean that this increase in loan, right? So mean that 9,600,000, we need to plus with 300,000. So 9,900,000. Okay. Next, trade and other payable. This one is not non-current liability, right? This one is current liability, right? So we go to additional information. Here we have loan, which is a financial liability. This one is still in leaseback. Remember just now we discussed there is a current liability and non-current liability. So therefore, in this case, loan under financial liability have current liability and non-current liability. Again, as per our discussion just now, okay, for current liability is the next year installment without interest effect because paid at the beginning. Therefore, we just put 650,000 only. Done. Okay. For non-current liability, okay, we see the balance first. Okay. And this what happened lah. Cancel balance first. And we minus the current liability. So this is the current liability. The rest here is the original balance here, 6,200,000, decrease because of the installment, increase because of the interest. This one, okay, and then less with the current liability, and then we get the balance of non-current liability by 5,178,000. Done. Financial liability we done, so I cancel everything lah. So all the additional information is cancelled already. So only one left here, which is trade and other payable. Trade and other payable, no adjustment. Put it here, and it is done. Total up, and make sure it is equal to whatever we put there. Sorry. One more is tax payable here. Tax payable here. I haven't do. Tax payable is the current liability. Okay. Just put it tax payable here and total up. So total up and it will be equal. Actually, that's it. Hope this video helped you. Okay. Thank you.